this analysis of the Union Budget 2013-14. First of all, I'll take you through the key highlights of this budget. So beginning with the gross tax receipts, with respect to the last fiscal year, this fiscal year's estimates exceed last fiscal year's by 19% approximately. The total expenditure with respect to the last fiscal is supposed to have increased by around 16%, of which the planned expenditure is around 29% and the non-planned expenditure is around 11%. Now coming to the income tax slab rates, those are what are the applicable rates for individual assessees, and in corporate assessees, the only difference is the surcharge applicable to domestic and foreign companies in the income bracket above rupees 1,000 lakh. Now the monetary impact, the revised estimate of the expenditure in the last fiscal year is at 96% of the budget estimate, which is pretty close and which is good. The last fiscal deficit target for the last year was 5.1% of the GDP, whereas the actual fiscal deficit for last year was 5.2%. The current year's target is 4.8%. The tax to GDP ratio, which is a very integral ratio for the economy, is targeted to be 11.9% for the next year, because this year it has dropped to around 5.5% for direct taxes and 4.4% for indirect taxes. The current account deficit in the current year, which is 2012-13, has been $75 billion, which is a huge sum. Again, the total tax gain for the next fiscal year is expected to be rupees 18,000 crore approximately, of which the direct tax yield is 13,300 crore and indirect tax yield is the remaining. Now the direct tax yield has a twist here, because there is a super rich tax that is in the form of surcharge of 10% charged to the individuals who fall in the income bracket of over rupees 1 crore per annum. Moving on, there were very few populist measures which also I would bring to your notice. One was the tax credit of rupees 2,000 for individuals who fall in the income bracket of 2 to 5 lakh per annum. Now the benefit for through this measure will go to around 1.8 crore taxpayers, and the outgo for the exchequer, that is the government, would be around rupees 3,600 crore. Now the additional interest payment deduction of 1 lakh which has been introduced is applicable only for first-time home buyers who will buy homes only in 2013-14, for which the loan amount must not exceed rupees 25 lakhs and the property value must not exceed a sum of rupees 40 lakhs. Now the salary cap for eligibility of the Rajiv Gandhi Equity Savings Scheme, which was introduced last year, has been raised to 12 lakh from 10 lakh last year. Now moving on to indirect taxes, first of all, customs duty, there have been very few increases in customs duty. The figures in the brackets refer to the figures of the last year in both the tables, and there have been very few decreases as well for customs duty, but the basic customs duty peak has been maintained at 10%. Moving on to excise duty, central excise standard rate has been maintained at 12%. Increases have been seen only in the areas of key consumer goods, and some branded ready-made garment manufacturers can avail exemption from payment of the excise duty provided they don't avail any input credit on excise. Moving on, service tax also hasn't seen many surprises. There's only one major change, that is all restaurants having air conditioning or central air heating facility are now liable to service tax. Also, GST has now been taken more seriously, and this year around a sum of rupees 9,000 crores has been set aside towards the payment of the first installment of balance due by the union government to the central government in respect of CST, that is central sales tax. The draft bill in respect of GST is to be introduced very soon in the coming months. Now, one major step that the government has taken this year is the voluntary compliance encouragement scheme. This means that there are registered service tax assessees in India of, there are 17 lakh registered service tax assessees, of which only 7 lakh actually file the returns. But this scheme is to address those 10 lakh non-payers who collect the service tax and do not remit it. So basically there is like an amnesty scheme, that is for the last 5 years, whichever service tax SSCs have not paid the sum to the government, the interest and penalty in respect of these SSCs is going to be waived off if they pay whatever due taxes are due by October this year. Now I call upon Ashish to take us through the remaining presentation.
Thank you, Shobha. Good evening, everyone. I'll be taking you through to the sectoral analysis of the budget. Construction seems to get a thumbs up from the finance ministry. We have seen a tax-free infrastructure bond allowed up to rupees 50,000 crore, which will lead to drive investments and infrastructure development in the country. Same goes with cement, where we see boost in cement demand and also boost in capacity enhancement, because there is an additional deduction which was spoken by Shobha, about 1 lakh additional deduction. Commercial vehicles, we see a reduction in excise duty from 14% to 13%, which will lead to reduction in the original equipment manufacturing cost. Moving on to consumer goods, 18% increase in special excise duty on cigarettes, and we will also have hike in excise duty on mobile phones price above rupees 2,000, which may lead to demand moderation of cigarette companies. Textiles Technology Upgradation Fund Scheme has been allotted an investment corpus of 1,51,000 crores for the 12th fifth-year plan period, which would definitely improve the cash flows and investments of textile companies. Even that, we see working capital loan available at 6% per annum, which would improve the capacity of the handloom sector. Banking recapitalization of 15 public sector banks to actually make it Basel III international norms. Opening of national housing banks with a fund of 2,000 crores, which we see infrastructure development is on the top list of the government. India's first women bank with an initial capital of rupees 1,000 crores, which will be started by the end of October. In capital goods, we have seen the government giving a thumbs up to 100 crore and above investments in plant and machinery, which will be entitled to investment allowance of 15%. This will attract greater investment and also job employment. Electricity and power, we see tax-free bonds of 55,000 crores, which will encourage fresh capacity additions by power producers. Roads and ports, two major ports have been established in Sagar, West Bengal and in Andhra Pradesh, adding a capacity of 100 million tons. 300 kilometers of highway road projects to be awarded within the first 6 months. Steel and iron, we see basic customs duty reduced from 5% to 2% and 6% to 2% on bituminous coal, which will decrease the price of steel and iron in the industry, and more specifically, since the demand increase, the cost of infrastructure development will reduce in the country. Agriculture seems to get green revolution to Eastern India with 1,000 crore rupees allocated, and agriculture farm credit kept at 7,000 crores to increase the overall productivity and crop diversification through technological advancement. Automobile, increase in automobile excise duty to 100% and increase in the allocated fund of JNNURM to 14,873 crores. The increase in bus demand will add actually 10,000 buses in the hilly states. Healthcare seems to get 37,330 crores with great emphasis on public health has been provided in the budget. Insurance, we have seen Rashtriya Swasthya Bima Yojana to be extended to other categories as well, such as taxi drivers, rag pickers, etc. Moreover, to open branches in tier 2 cities, less of policy making will be taken care, and public sector companies will be able to open their branches more easily. Speaking about a few missed points which we felt the budget had. The total expenditure is to rise by 16.4% year on year in FY14 compared to 9.7% in FY13, which means banking on higher tax revenues and asset sales to achieve the fiscal deficit target of 4.8%. While keeping in mind the fiscal deficit target of 4.8%, the government had a keen interest in mind of reducing the petroleum subsidies, which is a dependent variable and which depends on 3 core factors. One, the price of crude oil. Secondly, Indian rupee depreciation. And thirdly, the deregulation of diesel prices. For a government to control all these 3 factors is a tough task. When we move forward, deregulation of diesel prices will lead to increase in food inflation and inflationary pressures in the market. This being an election year, the minimum basic support price for foods will increase, which will lead to overspending of the government in food subsidy bill department. When we come to the revenues, we have seen a few areas in which revenues have been overstated. For example, a 32.8% increase in non-tax revenue incomes is highly overstated according to experts. Moreover, when we see on the revenue side, the disinvestment target, the government targets to earn 400 crore from communication services. Disinvestment depends upon the stock market sentiments, and it is actually very tough to take care whether we'll be able to achieve the fiscal deficit target of 4.8%. Budgetary proposals for the agricultural sector have been disappointing in the sense there has not been funds allocated to irrigation, thrust on irrigation remains absent, and moreover when we see activities of supply chain, where we see farmer to market linkages, supply chain activities such as cold storage and godown seems to get very little attention from the government. No clear financial direction towards enhancing exports of the country. For the last few quarters, we have been seeing the production of the country declining, even while exports of goods and services also declining at the same time. There is just a promise that we will ease out the foreign trade policy, but no particular financial decision has been made towards it. Over to Abhishek Bhai for the macroeconomic part.
Good evening, friends. Just to give you a perspective on the macroeconomic analysis of the whole situation, of the whole budget. This coming financial year, India faces more than many problems. That is, to deal with these problems. It's not working? Hello? So, to deal with these problems, we have to analyze whether the current budget has attended these problems or not. So, I believe, yes, it has. After the distress, financial distress in 2009, the central government came up with a stimulus package that artificially increased the consumption, but again, the investment climate suffered. That is because saving was not incentivized. We believe that if we follow this model, savings can be incentivized and investment can be increased. And in parallel to that, fall in inflation would also be seen as the savings would increase. Recently, after the financial distress, we have seen 2 to 3 basis points of decrease in the savings. So if savings can translate into investments, and then it can come out as a capital formation, that can obviously lead to GDP growth. Some of the steps that have been taken to incentivize savings in this budget are the Rajiv Gandhi Equity Savings Schemes, where the ambit has been increased to 12 lakhs per annum salary, and tax incentives will be given to for 3 consecutive years instead of 1. The other very innovative step that the Indian government has taken is the inflation index certificates and bonds. It is a bond in which the returns are guaranteed by the sovereign government, but they would be changed and adjusted according to the real income, adjusted by the inflation. Next is the STT, Security Transaction Tax. Although this step has been nullified by the Commodity Transfer Tax, but MF redemptions at the fund counters have been reduced from 0.25 to 0.001%. This is that the trading would be more mobile and less expensive for the current equity players. The last final 2 points are know your customer norms would be centralized. That is the FIS and FDIs. It is easier for them to register for the investment opportunities in India. And the last point is clarity of definition of FDI and FII. This is again just to mobilize the FDI and the FIS to invite them in India. These 2 steps have been taken so that the overall investment scenario is improved. Thank you.